The Bitcoin ETF was the most highly anticipated ETF of all time, and it quickly proved why. Since their approval by the SEC in January, spot Bitcoin ETFs have become the most successful ETF launches ever in the United States by a large margin. The new ETF funds attracted over $10 billion of net inflows during the first 2 months of trading alone. Before these, the fastest growing ETF in 1 year was Invesco's NASDAQ 100 ETF, the QQQ, which pulled in about $5 billion.
But when you look at the cumulative returns, NASDAQ since 2011 has done 769%. That's amazing, 17% a year. Well, Bitcoin's done 20 million percent.
Price predictions for Bitcoin over the next 12 to 18 months range from about $100,000 to over $1 million based on 3 critical factors. I'll share those factors later on in the video, including a few things that need to be confronted that others are incorrectly assuming based on lack of crypto experience. Now that the spot Bitcoin ETF has been approved and tens of billions of dollars have poured into the funds, many are asking themselves and their financial advisors if they should be allocating a portion of their investments to Bitcoin. Are you one of these people? I'm sure most of you watching this video have purchased shares in a stock ETF before, but maybe you'd be surprised to learn about how the Bitcoin ETF is different. In this video, I'm going to cover what you must know about the Bitcoin ETF before risking your own money, which spot Bitcoin ETF funds are available, and how to choose the right one for you. I'm also going to be sharing my 2 cents or 2 sats and what I'm going to be doing with my money. Then I'll finish up with the big 3 factors that will impact Bitcoin prices in the next 12 to 18 months. What is a Bitcoin ETF? A Bitcoin ETF is an exchange-traded fund that invests primarily in assets related to the original cryptocurrency, Bitcoin. ETFs sell shares to investors on the open market and use the proceeds to build a portfolio of assets. Until January 11th, 2024, due to the SEC regulations, Bitcoin ETFs could not trade Bitcoin at its current price or the spot price. Rather, fund managers had to own companies and other ETFs that were related to Bitcoin or cryptocurrency in general. Think about Bitcoin mining companies that were publicly traded, or they owned Bitcoin futures contracts. With the recent SEC approval of 11 spot Bitcoin ETFs, the Bitcoin ETF marketplace has become very crowded. However, history shows that many ETFs ultimately will change it to a different strategy or delist altogether. Not all of the new funds will draw enough shareholder money, which can be fatal for a fund. After all, a fund that charges 0.25% in annual expenses and only has $50 million in total assets would only generate about $125,000 a year in management fees. That's not a lot of money to market, regulatory compliance, and other necessary expenses for the fund to manage. How do spot Bitcoin ETFs work? Spot Bitcoin ETFs purchase a select amount of Bitcoin that are held in a secure digital wallet by a custodian. These custodians offer Bitcoin storage in a secure vault. Most of these vaults are, as crypto insiders like to call, air-gapped, cold storage, which means Bitcoin keys are stored offline and can't be accessed through the internet. The ETFs then issue shares that represent Bitcoins held by the fund. These shares are priced to reflect the current spot price of Bitcoin and can be traded on traditional stock exchanges. Spot Bitcoin ETFs make it easier for retail investors and traders to buy and sell assets tied to the current value of Bitcoin without needing to hold Bitcoin itself. They also allow investors seeking exposure to Bitcoin in retirement accounts to have a much simpler option than opening a self-directed IRA that could hold Bitcoin directly. How does a spot ETF maintain its price? The price of a spot ETF can depart from the actual value of the underlying asset. To bring the fund back into line with the asset's actual value, authorized participants, otherwise known as APs, are allowed to create and redeem large blocks of shares. APs are typically large financial institutions that profit from the arbitrage opportunity presented when an ETF's price is higher or lower than the underlying asset's value. For example, BlackRock has added Goldman Sachs, Citigroup, UBS, Citadel Securities, and ABN AMRO as authorized participants for the iShares Bitcoin Trust. This brings the total number of APs to 9 as they join Jane Street Capital, JP Morgan, Macquarie, and Virtue Americas. Popular ETFs tend to have over a dozen APs. How does a Bitcoin ETF price its shares? Well, the price of each share is different because each ETF owns a different amount of Bitcoin. and issues different amounts of ETF shares. The formula used to determine the price of a specific ETF is the number of shares times the ETF price is equal to Bitcoin price times the number of Bitcoin in the fund. Let's take, for example, BlackRock's IBIT fund. As of the close on June 14th, 2024, the IBIT share price was $37.30. Bitcoin's price closed at $65,426. The iShares IBIT owns about 305,591 shares of Bitcoin, and the outstanding shares in the IBIT fund was 536 million shares. When you multiply the price of Bitcoin by the number of shares owned, you get 19.99 billion. Then divide that number by 536 million outstanding shares, you get approximately $37.25.
It was my understanding that there would be no math.
Now that we know how a spot Bitcoin ETF works, let's get into how we choose which ETF to invest into. Unlike other ETFs that have a basket of stocks, the spot Bitcoin ETF currently only has Bitcoin as the only investment, which leaves us with three key differentiating factors: the expense ratio, the custodian of the Bitcoin, and the market capitalization or liquidity. Most people will look at the expense ratio first and see that most of the 11 ETFs listed have an expense ratio ranging from 0.19 to 0.25%. The obvious outlier is the Grayscale Bitcoin Trust GBTC with an expense ratio of 1.5%. Grayscale's process to launch the spot Bitcoin ETF was a bit different from the others. It converted its existing derivatives-based flagship Bitcoin trust, GBTC, to an ETF wrapper. GBTC used to have a 2% yearly fee. It was launched in 2013 and already had managed roughly $27 billion in assets. Before the SEC approved the spot Bitcoin ETF, Grayscale used futures to trade Bitcoin and offer the trust as an investment option. It's no surprise that Grayscale has seen large outflows of funds from its high-fee ETF to the lower expense options like the BlackRock IBIT. You can see this on the chart, and the red bars indicate the flows out of GBTC since its inception back in January. Let's look at how expense fees can cut into the total return on your investment. Vanguard is the king of low-cost ETFs and has a tool that shows the impact of expense ratios on your bottom line. According to Vanguard, the industry average ETF expense ratio is 0.24%, which is very close to what the most common Bitcoin ETFs charge, and Vanguard's average ETF expense ratio is about 0.06%. If you made an initial investment of $50,000 into the iShares Bitcoin Trust ETF, for example, you'd expect to pay approximately $19,000 in fees over a 30-year period of time, in comparison to just $4,800 for the average Vanguard ETF. That's about $14,000 in additional fees, and this is assuming a 6% return that doesn't account for inflation. What about Vanguard? Why don't they have a Bitcoin ETF? Well, Vanguard's new CEO, Salim Ramji, who is the former head of BlackRock's global ETF business, he told Barron's in an interview published on May 15th that Vanguard stands for consistency and that the crypto-related investment products don't align with their investment philosophy. Ironically, Ramji oversaw the launch of BlackRock's spot Bitcoin ETF back in January. The iShares Bitcoin Trust IBIT, which now has amassed over $18 billion in assets under management. It will be interesting to see how Vanguard changes their stance, if at all. It makes sense for investors to focus on the expense ratio of a fund, but what else should we be basing our decision on? As mentioned before, each ETF purchases Bitcoin and holds the digital asset with a custodian. The custodian must be approved by the SEC, and currently there's three. There's Coinbase, Gemini, and Fidelity Digital Asset Services. Most of the ETFs use Coinbase as a custodian, which makes sense because Coinbase is one of the most trusted organizations in the crypto world. It was founded back in 2012 by Brian Armstrong and continues to lead the cryptocurrency industry. The VanEck Bitcoin ETF uses Gemini as its custodian, which was founded by Tyler and Cameron Winklevoss in late 2015. If those names sound familiar, it's because they were the twins that had an idea that turned into Facebook by Mark Zuckerberg. Then we have Fidelity Digital Asset Services, which is Fidelity's custodian for its own Bitcoin ETF. Honestly, each of these custodians are solid, and if I were to be choosing one, it would be Coinbase. For most people that are new to Bitcoin, they may tend to trust a company like Fidelity over the other options. but there's something that Coinbase and Gemini have over Fidelity. The crypto industry is fairly new, and there have been numerous attacks and hacks over the years that have seen millions of dollars in Bitcoin and other cryptocurrencies stolen. Companies that have been in the crypto trenches like Coinbase and Gemini are more seasoned than the likes of traditional financial institutions. In my opinion, this gives those companies a leg up over security on the likes of Fidelity, but as I've said, I think they're all solid. So that leaves us with liquidity and the market capitalization as the other factor when it comes to choosing an ETF. When buying an ETF, a stock, or a cryptocurrency, it's best when there's a high liquidity in the event that you want to sell for the best price. As you can see by the list of ETFs here, there's a few that have a market cap greater than 10 billion, while the others range from 84 million to 3 billion. It's likely that the majority of investors will flock to the biggest funds like BlackRock and Fidelity just due to the overall trust and the liquidity that they offer. Based on all of this information, I'll share my 2 cents or 2 sats on which spot Bitcoin ETF is the best. Some fun trivia for you. Sats, which are short for Satoshis, is the smallest unit of Bitcoin. 1 sat is equal to 100 millionth of a Bitcoin. In other words, there are 100 million Satoshis in a Bitcoin. This unit's name is derived from the creator of Bitcoin, Satoshi Nakamoto. Based on the current choices we have, I see the majority of investments continuing to flow into BlackRock's IBIT fund and Fidelity's FBTC. Money follows the leaders, and most people will trust larger institutions with the longest track records and the best connections in the industry. For those that are looking to invest in Bitcoin and don't want to go through the extra steps of purchasing Bitcoin directly from an exchange or using a self-directed IRA, then choosing one of these ETFs with a low expense ratio and an above average market cap is how I would invest my money. While I currently hold the majority of my Bitcoin in cold storage outside of a retirement account, I do have some invested in the IBIT ETF. If you're interested in buying Bitcoin directly in an IRA, let me know down in the comments below and I'll do a video on a self-directed IRA options that allow you to purchase cryptocurrency in your Roth or traditional IRA. Now let's talk about what could impact Bitcoin over the next 12 to 18 months. There are 3 critical factors that could make Bitcoin explode in value. The first is the US election happening this November. This will be the first election in which cryptocurrency is a key topic that any candidate will have to address. We're already seeing both parties, both Democrats and Republicans, become more crypto-friendly as they're beginning to realize the importance of capturing those votes. Politico's article titled "Crypto's Huge Moment Scrambling US Politics" is a perfect example of how both parties are pushing to be seen as pro-crypto. No matter which way you lean politically, it's positive for Bitcoin and other cryptocurrency when the presidential candidates both realize they need to make progress on the policies that the industry has long been sought after. Another critical factor that could push crypto prices into a massive bull market is the global liquidity cycle. Raoul Pal is a former Goldman Sachs executive and a crypto expert who shares how the global liquidity cycle impacts the performance of cryptocurrency. Here's a recent clip from his YouTube video on his Real Vision channel.
So in summer, liquidity starts increasing. Obviously, 2020, because of the pandemic, it went bananas. But 2016, 2012, these were good periods for liquidity. And guess what? Crypto, technology, they all rose. Then you get into fall. Fall is often when the real fireworks happen.
Raoul Pal expects the trend to continue and for the Fed to lower interest rates and print more money leading into the fall of 2024. One of the key drivers to any asset class's price is the adoption from institutional investors. When institutional money begins to flow into an asset, it usually creates a surge in price due to the increased demand. It's becoming increasingly difficult for institutional investors to ignore Bitcoin when you look at the performance compared to other assets over the last 14 years.
But when you look at the cumulative returns, NASDAQ since 2011 has done 769%. That's amazing. 17% a year. Well, Bitcoin's done 20 million percent at 139% annual.
There you have it, the big 3 factors that could drive the price of Bitcoin up in the next 12 to 18 months. If you're considering adding Bitcoin to your retirement portfolio, I'd recommend watching this video next. I'll share how Bitcoin can surpass gold's market value including alternative ways to invest in the asset. Thanks for watching the video, and I hope something great happens to you today. If you haven't already, hit that subscribe and the like button, and we'll see you next time.